wondered why your wallet seems to take a hit every time the market crashes, but Wall Street always magically recovers? Well, let's dive right into this explainer. Today, we're unpacking a highly provocative text that totally reframes how we look at economic history. Instead of viewing historical market crashes as just unfortunate accidents or, the natural byproducts of a free market, the source material frames them as intentional, repeatable designs. It is a fascinating deep dive into what the author calls the financial architecture of systematic wealth extraction.
The text we're examining makes a seriously bold claim right out of the gate. It essentially asks us to reconsider everything we know about finance, launching this massive historical investigation into how our systems have evolved. But here's the catch. According to the text, they haven't actually evolved to become more efficient engines of human progress. Instead, the author argues they've been fine-tuned over centuries to systematically transfer wealth away from the public and directly into the hands of a select few. It's kind of like finding out the rules of the game were written specifically so you can win.
To explain how this works, the text defines a concept called financialization. It describes this as the creation of mechanisms that allow a small group to extract value from the productive activity of the many, all disguised as natural commerce. The author asserts that this is a recurring blueprint. It's a system engineered with such precision that regardless of the era or the specific asset being traded, it always ensures the house wins.
To see where this all started, let's look at the blueprint of speculation.
To really grasp how this modern blueprint operates, the text argues we actually have to look backward all the way to the 1600s. Now, we often hear the Dutch Tulip Mania dismissed as a silly historical moment where people essentially lost their minds over gardening. But according to the source, this era actually established the ultimate template for financial extraction. It started with the Dutch East India Company in 1602, which was the exact moment corporate ownership became a liquid asset, effectively monetizing colonial exploitation. And that laid the groundwork for the tulips. Buyers were trading futures without ever holding a single bulb, fueled by intense speculation and massive margin debt. And the most critical part of this template, well, when the credit dried up and the bubble finally burst, established institutions simply voided the small speculators' futures to protect themselves. The house saved the house, while everyone else just went broke.
So, how did this system spread? Let's talk about selling markets to America.
Think about this number for a second. $20 billion. That staggering figure represents the value of securities sold by National City Bank during the 1920s. But how exactly did we get there? Well, the source details how this speculation blueprint crossed the Atlantic during World War I. The U.S. government used massive Hollywood stars like Charlie Chaplin to sell Liberty bonds to patriotic citizens at a loss, which introduced everyday working-class Americans to mass financial investment for the very first time. Fast forward to the 1920s, and National City Bank's president Charles Mitchell realized he could totally repurpose that exact same patriotic marketing. He transformed his bank into a retail speculation engine, using high-pressure sales tactics to push risky securities onto ordinary depositors, people just like you and me.
But, of course, that pyramid of debt couldn't hold up forever. When the system collapsed under the weight of massive margin buying and institutional pump-and-dump pools, the results were absolutely catastrophic. The Dow didn't just dip, it plummeted by an astonishing 89%. Everyday citizens suffered staggering unemployment and totally wiped out savings. Meanwhile, the architects of the crash, the leading bankers and pool operators, largely escaped any real consequence and simply retained their fortunes.
This catastrophe led to what the text refers to as the brief regulatory interlude.
Following the absolute devastation of the Great Depression, policymakers realized that unregulated finance had produced a disaster so severe it literally threatened the survival of capitalism itself. So, they implemented New Deal regulations like the Glass-Steagall Act. By officially separating commercial and investment banking, they successfully constrained these extractive excesses, stabilizing the system and allowing the middle class to grow for about 50 years. But starting in the 1980s, the source argues an ideological commitment to deregulation took hold and the guardrails came completely off. Interest rate ceilings vanished in 1980, the savings and loan industry was deregulated in 1982, Glass-Steagall was officially repealed in 1999, and crucial over-the-counter derivatives were exempted from oversight in 2000. According to the text, this deliberate, piece-by-piece dismantling paved the exact road that led us directly to the 2008 global financial crisis.
Which sets the stage for our next major shift, the modern wealth transfer.
After the devastation of 2008, you might expect a return to tight regulation, right? Well, the text argues the exact opposite happened. Instead of restructuring the broken system, central banks introduced quantitative easing, purchasing trillions in bonds to artificially inflate asset prices, which, you guessed it, disproportionately enriched the wealthiest 10% who actually own those assets.
This strategy builds directly into what's called zero interest rate policy, or ZIRP. To put that into perspective, imagine you're a retiree with $100,000 in savings. Because of ZIRP keeping interest rates near zero, you effectively lose $4,500 a year in normal interest income. The text argues this money doesn't just vanish into thin air, it is essentially transferred from ordinary savers to subsidize incredibly cheap debt for large corporations and private equity firms.
The author actually calls this justification semantic fraud. Central banks target a 2% inflation rate, sure, but they conveniently use a consumer price index that completely excludes the things that cost the most, housing and financial assets. So while officials are patting themselves on the back for maintaining price stability, the reality on the ground is the S&P 500 goes up 600% and median home prices double. The text argues this deliberately obscures policies that transfer wealth upward while quietly pricing ordinary people completely out of a stable middle-class life. And that brings us to the really hidden machinery inside the shadow system. Because of the few regulations placed on traditional banks after 2008, a massive $2 trillion shadow banking system has emerged. The source describes this private credit market as the most sophisticated and, crucially, the most opaque wealth extraction mechanism yet devised. Let's look at how the Apollo-Athene model works according to the text. Step 1. Originate a high-risk middle-market loan. Because it's private, you get to subjectively determine its value yourself, totally without public oversight. Step 2. Sell that loan to an insurance company that you already own, letting them absorb the risk. Step 3. Just sit back and collect enormous management fees at every single stage, regardless of how the loan actually performs in the real economy. The author points to this as a textbook conflict of interest.
Even global regulators are just beginning to understand the danger here. The International Monetary Fund has identified severe structural vulnerabilities in this private credit space. We're talking fragile borrowers, subjective valuations, and multiple hidden layers of leverage bundled into semi-liquid vehicles. But the real alarm bell? The unclear interconnections with traditional banks. If these shadow loans default, the text asserts that the losses won't just stay in the shadows. They will inevitably bleed directly back into the mainstream banking system that holds your deposits.
Which leads us to a pretty ominous section of the text, the next financial catastrophe.
The ultimate consequence of this centuries-old template is incredibly stark. Just look at the breakdown today. The top 1% owns roughly 45% of global wealth, while the bottom 50% owns less than 1%. The author argues that the labor and savings of that bottom half have been systematically extracted over time to enrich a tiny, entrenched elite. This matters immensely because this massive wealth gap leaves the global economy profoundly fragile, meaning it's heavily reliant on the next big speculative narrative just to keep the engine running.
And that brings us to the author's grave warning about our immediate future, the current artificial intelligence debt bubble. Right now, tech giants are investing billions into AI startups, with the explicit expectation that those startups will use that exact same money to purchase hardware right back from them. It's a circle. With over $1 trillion in junk-rated debt expected to fund AI data centers by 2028, the alarm bells are ringing louder than ever. Major institutions like the Bank of England and the IMF are explicitly warning of a crash that directly resembles the dot-com bubble, and the source warns that when this bursts, the losses will cascade right through pension funds and banks, once again socializing the losses while the profits remain aggressively private.
So as we look at the centuries of historical evidence presented by the source, from Dutch tulips all the way to modern private credit, we are left with a vital, pressing question. When the current system inevitably fractures, will policymakers finally change the blueprint and restructure the system? Or, as history strongly suggests, will they just force the public to pay for the house's losses once more? It's a really provocative thought to leave you with, and definitely one that demands our close attention.